Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wallberg, and I have a rare double header on the books today. I'm joined by Enterprising Investor veteran Mike Higgins and Leyla Kunimoto. Leyla is the founder and editor of Accredited Investor Insights, a newsletter that helps investors navigate private markets. She writes about private equity, private credit, and real estate, focusing on the practical realities of evaluating alternative investments from the limited partner perspective. Listeners may recall Mark published an excellent book about 18 months ago called Investing in U.S. Financial History. I had him on the show back then to talk about it. He's been featured in different capacities a few times since, including a conversation about private credit at last year's Institute conference, which was rebroadcast here. Both he and Leyla have been prolific in publishing and speaking to the media about emerging and now more blatant cracks in private markets, but coming at it from slightly different angles. I'm excited to hear their perspectives on what's been an area of personal interest and research, the evolving state of private markets, and its prognosis. A big welcome to the show to you both.
Thank you for having me.
Thank you so much.
So one of my challenges in preparing for this interview is knowing really where to start with all of this. So Mark, I want to go to you next for a historical perspective, but Leyla, as an expert on the day-to-day developments in the funds themselves, perhaps you could help set the table for the discussion, maybe give us a brief summary of the current health of private markets and really what's been on your radar in the last sort of 2025, 2026.
So let's start with what's been really on the headlines over the past so many months. And what we've been hearing about is some cracks appearing in the private credit space of the private markets, specifically in evergreen, semi-liquid, evergreen private credit funds. And this is what's happening today is an exodus of retail capital out of those vehicles. Those vehicles raised a lot of capital from about 2021 on. There's been a lot of money flowing into that space. And what we're seeing now is a very rapid outflow of that capital. In Q1 of 2026, there's been about $4.6 billion that's currently stuck in the exit queues out of those vehicles. So the fundraising was still pretty robust up until about now. And as of today, we have quite a bit of capital sitting in the queues, exiting those funds. And what's going to happen next is, I think, is the most interesting question. And that's where Mark's perspective might be very helpful.
Yeah, I wanted to ask you, Mark, so given your knowledge of the history of financial cycles, that gives you really a unique insight into where we are today. So how does the current cycle we're experiencing not surprise you?
The interesting thing about these cycles is a lot of times the tells they're not in the data, and that's where people get tripped up. So when you hear private credit fund managers and semi-liquid fund managers talking about, well, defaults are low, even though there are some signs that Leyla can talk to that they may be a little higher than reported. But it's just and I talked about this in May 2025, it's at a very fundamental level, when you see a couple attributes happen with an asset class, it's usually a bad sign. And I outlined this in one of the articles. I talked about this at CFA Live. The three attributes that are concerning is you have a huge influx of capital into an asset class. I mean, massive inflows into private credit over the past 10 years, and especially the past 5 years. Everybody kind of latching on to this narrative that it offers better diversification, enhanced returns without much focus on the risk. And you have very aligned incentives driving that. And historically, when you see things like that, whether it was land in the 1810s, the dot-com bubble, the real estate during the GFC, it breaks. And the most concerning thing, and I actually learned about it from Tim, both Leyla and I talked to Tim McGlynn a lot, and he came up to me after the presentation in May 2025 and told me about what the semi-liquid funds were doing with this concept called NAV squeezing, which we'll talk about later. And that was like the final nail. So now you have runnable funds that are marketing this to retail investors. And that's where the alarm bell really went off, was actually at that conference.
Yeah, I wanted to talk about NAV squeezing, actually. Leyla, that's as a symptom of markets in excess. I think Mark would agree with me on this, is a rise in Wall Street behaving badly. Can you talk to NAV squeezing? What is that, and what does it mean for investors in, specifically, I know it relates to secondary funds.
So for listeners who are not familiar with how secondary funds work, let me give just a very brief kind of description of what goes on in those secondary funds. So a fund manager can raise money, go out and buy stakes in other funds. And typically those stakes can be bought from GPs or LPs. So if you have a large endowment that wants to exit their investments, they will go to the secondary market. And let's say they have 10 funds with the average vintage of 2019, and they'll sell those 10 stakes to a secondary buyer. The secondary buyer, when they buy those stakes, they will typically negotiate some sort of a discount on the par value. And the accounting rules, specifically ASC 820, allow for use of NAV as NAV as practical expedient to mark those stakes on the books of the buyer. So let's say Mike, you are an endowment, and I am a fund manager, a secondary fund manager. You sell me some stakes, and let's say the par value of those stakes is $50 million. You and I talk, and I buy them for 40. I can then take that $40 million purchase, and if the par is $50 million, the next day I can mark it up to $50 million and have an unrealized gain of $10 million on my books. And that's effectively every single secondaries fund does it. This is an accounting rule. It's in place to make accounting for those illiquid assets easier. And it's really those assets don't have it's not easy to price them. So this rule allows accountants to mark those assets on the books of the funds. The problem is, let's say, Mike, you are an endowment number 1 and Mark is a pension fund, and between the two of you, you own 100% of LP stakes in a certain fund. Hypothetically, the rule allows both of you to sell them to me at a discount. Let's say you sell them to me at a 20% discount. So I buy the entire LP stake in a certain fund from different parties. We have a market transaction that shows that I bought it for 80%, for 80 cents on the dollar. Despite that, I can still turn around and mark this up to 100%. So that brings up the question of how do we value these really illiquid assets? And what really is the value? Is the value the price I paid, or is the value of what the underlying fund manager says the value is?
And the interesting thing about this is this is more with private equity positions than private credit positions. And over the past year, me, Tim, Leyla, some other people as well have been writing. My gut feeling was this was the real problem, that when there was a run, there was going to be a run on the private equity funds. And then you have the added element of there's a good chance that they're marked at values that are far above what they can actually sell them for. And the reason that's a concern is because the run on the private credit semi-liquid funds is concerning in and of itself. But ironically, my gut feeling, and Leyla, you can jump in on your feelings on this, is the private equity funds are actually worse and more dangerous in terms of the potential write-downs.
I agree with you on this one. I think private equity funds, especially secondaries funds that don't generate cash flow, are at a much higher risk for, breaking, and maybe breaking is too strong of a word, but for having some severe liquidity issues. Private credit, there's a million different flavors to private credit. Let's define the universe that we're talking about today. Let's talk specifically about middle market direct lending. This is the evergreen funds that are marketed to retail investors are mostly in that universe of middle market loans to other companies. Private credit, of all things that are unsuitable to put in a semi-liquid fund, private credit is probably the least bad. You have high cash flow from underlying assets. You have high turnover of portfolio. Typically, 20 to 30% of the entire portfolio will turn over annually in each of those funds because those borrowers pay off the loans. So that asset class is actually the best suited for this structure. And it's going to be very interesting to see when you have a fund that has, 40% of investors in the queue for exits, how's that fund going to navigate that? And I would argue that a private credit fund will have an easier time navigating this than a private equity secondaries fund, where assets are really not liquid, where they're not trading, where they don't pay off. Those are long-term assets, 10, 12-year stakes in some funds, 10, 12-year positions in some funds. So those funds are going to have a really difficult time coming up with liquidity.
And then you add on the other, and Layla and I were talking about this yesterday, just preparing for this, but think about, especially venture-oriented secondary positions, a lot of these companies probably have software companies in them that have aged for a long time. So there could be write-downs there as well. Well, it's just, if it spreads, which I have no reason to believe it won't, the private equity could be a lot messier.
So do you think this early move, sort of the spooked investors they're heading to the gates right now, is this just on like performance, or realizing, hearing headlines and it's causing a contagion in terms of, oh, my friend is in this fund and can't get out, so I'm going to get in the queue? Or like, what do you think is driving this initial sort of run?
I think what's driving it is not performance, because so far there is no evidence that those underlying loans are underperforming. We still have very low default rates, although they're ticking up, but they're still pretty darn low, right? We're not hearing about a lot of defaults in the companies. What's driving it is the sentiment. There are worries about software companies. By and large, direct lending, private credit, middle market direct lending is very exposed to software. So it's, estimates vary, but it's anywhere from 20 to 25% of all of that universe is exposed to software companies, software borrowers. So you have a couple of problems. There's sentiment that AI is going to eat SaaS companies, and therefore those borrowers are not going to be able to repay the loans. And the second part of the problem is a lot of those borrowers borrowed, a lot of those loans are ARR loans. Those companies do not cash flow sufficiently to cover the interest on the debt payment. And they were underwritten with certain assumptions of future growth. And now there are questions whether this growth will materialize. So we're not seeing a we're not seeing the deterioration in quality of the assets right now. What we're seeing is the sentiment that drives investors to go and ask for their money out. And I wrote about this, and a lot of that money is retail money through access those funds through the wealth channel. There is no penalty to ask for a redemption. You can redeem at NAV at 100% of par. Those those funds were marketed as semi-liquid, and investors are thinking, what's the penalty? Why can't I take my money out and sit on it for a couple of quarters and see where the dust settles?
And here's the thing that often gets missed too, and I think it's important from a historical perspective, is people assume, and I think it's because they read back into crises to see what happened, and they see they focus on the deterioration of returns and defaults and things like that, and they don't realize that that's a lagging indicator. When I wrote Investing in U.S. Financial History, I read into crises, and so you start seeing the language that gets used, and you realize that the run usually comes before the deterioration. So people like to claim that, well, it's just headlines. That's actually usually how it plays out. And the funny thing, and Layla and I were talking about this yesterday as well, is blaming the media is very typical. You saw that in the global financial crisis. You see that in every crisis. They always blame the media. But the funny thing is, the media is actually usually pretty late. I mean, we've been writing about this for a year now, and the media was largely confirming the story that private credit and semi-liquid funds are this great new innovation. And it's not an innovation, by the way, very slight innovation, which just is very typical in these situations. It's not really an innovation. It's just resurrecting something that's failed before. But the media usually comes in late, which is ironic, but they always get blamed.
Yeah. Yeah. And I mean, it's true of public markets as well, right? The market will always correct well ahead of
Yeah.
recession, well ahead of any disappointing news. They often, somehow it knows, right? In this random walk. We've seen that certainly up in Canada here, had a lot of movement around, specifically around real estate funds. And that's where my question was coming from, because we have seen some of these funds that finally start to take their lumps. Valuations were kept high for a very long time, and then suddenly investors are waking up and realizing they're actually losing money on some of these funds, or they're, reporting 1-2% in a market that's up 15. it gets me back to this question of the pricing. And so you talked about NAV squeezing. It's a legal and GAAP compliant way of reporting that gives a crazy juice to your performance as the managers, because that's the other part of what you're describing, right? Is these guys that did this can now turn around and market these incredible returns and then, keep the Ferris wheel going, right? And so
Mhm.
what about like valuation governance? Do you think that anything is coming? Is there any developments on that side in terms of from the regulators around NAV squeezing specifically, or around just making sure that these marks are somewhat current and not 3 years out of date?
Well, I want to jump in on this one. I sure hope so. And ironically, literally just a couple days ago, Layla, myself, and Tim McGlynn just submitted an official agenda request to FASB to take a look at this. And, one of our regrets was Tim and I actually had a call with FASB 2 days after the agenda requests were due last year. And I wish we had pushed it last year. But the issue which Layla articulated before is the practical expedient was really that's what it's called. It's an expedient for reporting purposes, and that's what it was originally designed to do. It wasn't designed to accelerate marketing efforts, and the conditions have dramatically changed since that guidance was issued in 2009. And yeah, I think it needs to get changed. But that's my two cents. Too, Layla, you can definitely jump in as well.
Yeah, I'll just add that it creates certain incentives for fund managers. When a fund manager, there are funds that will crystallize carry on unrealized gains. And what that means is that the fund manager, by marking up the assets, generates unrealized gains. This is just paper marks, right? But the fund literature allows them to then get paid real dollars on those unrealized gains. And the incentive then becomes it creates this funky incentive when hyperbole this. um, Hypothetically, it creates an incentive to buy really bad assets at the highest discount possible, just so that you can mark them up and then generate those unrealized gains and show wonderful performance on the one hand and attract a lot of new capital. And then on the other hand, if that's the structure of the fund and if that's the compensation structure, on the other hand, then the fund manager can get paid on those unrealized gains.
And everyone, and especially the latest money dollars in, or get left holding the bag on that terrible portfolio.
Yeah, I mean the payment of incentive fees on unrealized gains from that are literally recorded in a day is I mean it's pretty epic in terms of the Gilded Age people that ran the markets would be like, why didn't we think of that? I mean, it's pretty epic.
So, Layla, you talked to continuation big vehicles there a little bit. I'm wondering. I have a heading on my script here that's called "Structures of Escape." So, what are managers doing with portfolios that either they're trying to extend the life of them, or what are some of the structures that managers are using to continue keep the ride going?
So to keep the ride going, there's really not a whole lot of options for the managers, right? So if a private equity fund manager has, let's say, 10 portfolio companies on their books, and they roll out fund one, they buy 10 portfolio companies, and of those portfolio companies, typically they will hold them for a number of years, sell them, pay off their LPs, generate returns, and close off the fund when all of the companies are sold. Well, we're hearing, and Bain is publishing a lot of good information on this. We're hearing about the exit bottleneck. There's a record number of companies that are held on the books of fund managers, and the holding periods are extending. There's a mismatch between, I think, what funds are willing to transact those companies at and what buyers are willing to pay for those companies. So we're seeing a lot of companies that kind of linger on the books. We're seeing a lot of LPs who are saying, I want my money out because, I have other commitments or I want to redeploy into other asset classes. And one of the escape mechanisms is the continuation vehicle. And that's when a fund manager sets up a second fund and transfers assets from fund number one to continuation vehicle number one fund or fund number two. There's a lot of information, both organizations are writing about the incentives and how misaligned they are and the concerns LPs have about this, because the fund manager who owns those assets is effectively functioning as a seller and a buyer of the same asset. So there's a conflict of interest, right? And they have a fiduciary duty to their LPs in fund number one. So for fund number one LPs, their duty is to get the highest possible price. For fund number two LPs, their duty is to get the best possible basis, so the lowest possible price, right? So it kind of creates this tension. There's an academic paper that's an outstanding. They did a great job, and what this paper highlighted is that many such vehicles, many such fund managers, when they come to their existing LPs, they give a very short time frame to make a decision on whether to reinvest or not. And it's just from the outside looking in, I can see the conflicts of interest. I can also see, the reasoning is sometimes, and yes, the funds need to generate exits and need to pay off their existing investors. We're back to the conversation about valuations. How do we value an illiquid asset when there is no third party bid? When we're buying and selling the asset ourselves, right? And the asset is illiquid in the first place. How do we make sure that the valuation that we say it's transacting at is an accurate valuation, or it's a fair valuation?
And just use human nature. Do you think it's going to be a high valuation or a low one? I mean, this is where you just need to think how humans behave.
Yeah, I was saying you could ask the Blue Rock unit holders, like when you send it to the public markets, they'll tell you, right? And maybe one of you can talk about what happened there.
I'll take this one. I've covered it pretty extensively. So what happened there is this is a good example, Mike, of you talked about real estate funds running into issues in Canada right now, right? So this is a US-based interval fund that was in existence since 2012, I think is the vintage of that fund. And it did really well. And it's a secondaries real estate fund. So the fund itself did not own real estate. It bought stakes in other funds and did used NAV as practical expedient to mark up the books. They showed beautiful returns for the first so many years and attracted a lot of new capital into that fund. Well, at some point, US real estate valuations started going down in about 2022. So the underlying funds started marking down NAV of their own shares. And this fund using practical expedient works both ways, right? So you can mark up, but when the NAV goes down, you have to mark down. So this fund started marking down the NAV of its own shares. And that effectively creates a situation where there are negative returns. What do retail investors do when returns turn negative and they're told that the fund is semi-liquid? They hear the liquid part and they say, well, party's over, let me take my money out. So this fund experienced a pretty sizable run. They gated, so the mechanism worked. They put the gates up so that they wouldn't have to fire sell the assets, which is what it's designed to do. And for a number of quarters, the fund was gated, and the number of investors who wanted out kept steadily increasing. At some point, as a fund manager, you have to do something about it. And this fund decided, and there's not many options. You can borrow money, you can sell assets. Both of those things will effectively shrink the fund. When you shrink the fund, your underlying fees shrink with the size of the fund, typically. One option that's available to fund managers is to list that fund, to IPO the fund, and to list it on a public exchange. And that's what Blue Rock did. And when it listed, the price it was trading at the first couple of days was a 35% discount to NAV. So effectively, investors who were in queue to get out and really wanted to get out, if they sold those shares immediately after the fund listed, they got the liquidity, but they also took a 35% haircut on that liquidity. It's still trading at a discount. I haven't checked. It's a good question where it's at.
So if we're truly in the late stages of what's basically a multi-decade capital cycle, maybe I'll send this one to you, Mark. What signs should investors watch for next? And what lessons should they take from history on this? Where do we go from here, and what are the ways this gets worked out?
So I often talk about the run. To me, we're in the beginning of it. And when Cliffwater hit the 14% on one of their funds, and then I'm sorry, who hit the 20? When Blue Owl hit the 21% and like 40% or something like that. To me, that was a sign that the threshold has clearly been crossed, and it's going to accelerate and it's going to spread. And in these situations, historically, if you don't have a lender of last resort, you have a big problem, and they don't have a lender of last resort. So I think we're very early. I think it's going to spread. It's going to get worse. It's going to when you see runs like this historically, I remember we were talking about this, Leyla, like 3 months ago, and it's like when this happens, it's going to happen faster, and it's going to be more dramatic than you think, because they spread really, really fast. So I think that's going to happen. And the signs to look for to avoid situations like this in the past, honestly, it's the thing over the past year, the thing that was most telling is just the growing disconnect between the narrative and just observed reality. The gulf just keeps getting wider and wider and wider between what people are saying and what like your lying eyes see, I guess. And I mean, John Kenneth Galbraith used to refer to this as absurdity. I mean, some of the things that are coming out are just plain absurd. And I remember one thing that set me off um, on the skeptical path was reading, it was National Bureau of Economic Research working paper, I think it was in 2024, looking at returns of private credit. And they described why these loans are attractive. And they were saying, they're loaning to riskier borrowers, so things get a higher, demand a higher yield. And then the borrowers like the speed and convenience of the loan approval process and the flexibility of the terms. Well, what kind of borrower is that going to attract? I mean, it's going to attract somebody who can't get money elsewhere and is willing to pay a premium. Probably is not going to pay it back. Or in the worst case scenario, they never had any intent to pay it back to begin with.
Sounds like
And
subprime, doesn't it?
it's just there's a great quote. I posted on this recently from Charlie Munger where he said, people need to calculate less and think more. Just think about what people are saying and does it make sense? Because a lot of things that are coming out of people's mouths right now just doesn't make sense.
So in terms of practical sort of consequences for this, I mean, I know in Canada here, one of the funds, real estate funds, recently just decided to shut it down. I mean, they're going to wind it down. Basically, they blocked their investors' capital in. They didn't go to a public vehicle for that, but it's effectively a closed-end fund with no secondary market. Do you think that's basically what we see, is some of these funds just basically close the gates forever until they can sell the assets out from within them?
Layla's going to be the better person on that. What are the different exit options?
Yeah, I think we're going to see a lot of IPOs. I think that's going to be a more attractive option. I think so. We saw OBDC2, one of Blue Owl's funds, attempt merger back in like 6 months ago in November with their publicly listed vehicle, and that got shut down. That was a very unpopular measure because at the time had investors, they were basically redeeming investors out at NAV per share in both vehicles, but one of them was trading at a 20% discount. So this was super unpopular. Effectively, investors who wanted to get out would have taken a 20% haircut on their shares. I think we're going to see a situation where some investors are going to be more amenable to take a haircut, and they're going to say, you know what, I want liquidity, I want my money out, even if it's going to cost me something. So we will see more third-party tender offers on those closed-end vehicles. We're going to see more IPOs, and we're going to see, and some funds are not going to make it. Some funds are going to have to shut down and effectively liquidate the assets. And
Yeah. Well, I've been singing from your song sheet for a long time. I wrote an op-ed for the Globe and Mail up here in Canada a couple of years back. The gist of that, though, is that the illiquidity is not a problem with private funds. It's a feature of it that needs to be understood and respected. And what you guys, I hear you guys talking about it similarly, is basically it's about suitability, right? So it's not a bad structure. It's just a bad structure for investors who need access to their capital. So
No, I think it's I would go further. I think it's a bad structure. I do. I think historically, maybe not universally, but generally, particularly with retail investors, history just has too many of these examples of non-bank entities that don't have access to a lender of last resort or unregulated banks back in the 1800s of investing in illiquid hard to price and hard to value securities, and then layering liquidity on top of it. And if you lack a lender of last resort, they are going to run eventually. It's very, very predictable. And that's predicting when is hard, but predicting if is not. And there's just too many examples of this. It's not a good idea. It's just not.
So trying to put a positive spin on what's been a very bearish and frank conversation, but and I agree with you. Like nine retail investors out of 10, this is not appropriate. Maybe if you've got $20 million to $50 million and and it's only a 10% of your portfolio, that's my own personal perspective. But aside from skipping them all together, if they can't handle the illiquidity, how can investors tell a good private asset fund from a bad one, and do they even have a chance to do that?
I already provided my answer, so I'm going to go to Leyla on that one.
Oh, this is hard. And I think any investor who is evaluating those funds, okay, to put a positive spin, there are good funds. There are better funds than others. And it is possible to tell. It is hard. Investors need to be well educated and they need to be looking beyond the marketing materials. Marketing materials are going to show you IRR, and that IRR can come from a number of different things. Marketing materials are going to show you a distribution, and they can name you 10, 20 funds off the top of my head that pay distributions out of investors that don't generate enough net investment income to pay the distribution rate that they're paying. So I think that's the first step for any investors, to look beyond the marketing materials. The good news about 1940 Act funds is that a lot of information is available publicly. You go on the SEC website and you can see what they're doing quarter to quarter and learn to read financial statements and see how those returns are generated. And if the returns come from realized sales of assets, if it comes from the cash flow, if you can see how the cash flow is covered by the cash yield of the underlying assets, that's a good starting point.
I will say, in an ideal world, if people were doing the kind of analysis that Leyla was doing, maybe this wouldn't be, well, definitely wouldn't be as big of a problem. People don't look at these things. And so, uh, in theory, I agree with what Layla's saying. The problem is there aren't many Laylas out there doing this, and you shouldn't be investing in this stuff if you're not. And I think that population's pretty small.
Is the horse out of the barn now too, in terms of like access to 401ks and all that? I guess that's already done deal down there, hey? Yeah.
Well, if they, whether they put them in or not,
Yeah.
is another issue. But it looks like it's moving in that direction. It's a proposed rule right now, but yeah, it looks like it's moving in that direction, which I think is a bad idea.
Yeah.
If I
Yeah.
were to bet, it's going to be available in our 401ks in 18 to 24 months.
Yeah, we've seen some pressure up here as well. Specifically, I was a little disappointing for me personally, was just that our federal government has also talked about wanting to engage retail investors in helping fund P3 projects, because we've got all this infrastructure we want to build up here. And there's, talking about the value that our pension funds have realized over the years in being infrastructure and private asset investors, and talking about getting every man involved with that. And I hope that they don't go too far down that road myself. That's my own bugaboo. But
And one, backing up on the, I know I sounded pretty absolute on these vehicles. It's the semi-liquid feature that's the problem. I mean, if it wasn't for that semi-liquid feature, I personally don't think this is a good idea, because people generally don't do the due diligence that's required to invest in them, even if it wasn't for the semi-liquid feature. But it's the semi-liquid feature that's the killer, because that makes them runnable.
well, we are coming to the end of our conversation. Unfortunately, this has been actually a lot of fun for me. Mark, you've answered this question before, so you get a day off today. But Leyla, what was your first job in the industry? And if you could go back and take yourself for coffee on your first day, what key piece of advice would you offer yourself?
So I will say that I'm a complete outsider to the industry. I look at this as an investor. I am the target. When you hear about democratization of those alternative investments, I am the target of those funds. So my first job in finance was actually in consulting for a Big Four accounting firm. And if I could go back in time many, many years ago and take myself out, I would say that the most important skill is doing the hard, grunty work that seems totally meaningless. It's building those Excel spreadsheets and looking at the financial statements that gets it so deep into your bone marrow that I fundamentally understand which inputs can be manipulated to show really nice IRRs. I just know it. It's in my bones at this point. So for anybody who's out there struggling with this, I think it's boring and meaningless, but I think it's one of those skills that stays with you for the rest of your life.
I have been speaking today with Leyla Kunimoto, founder of Accredited Investor Insights, media commentator, and prolific LinkedIn influencer. I'll call you an influencer. Hope that's okay with you. I've also been joined today by Mark Higgins, Senior VP and Advisor at Index Fund Advisor and author of the book Investing in U.S. Financial History. Mark is also active on LinkedIn and a frequent contributor to the Enterprising Investor blog, including recent posts, "Incentives are dangerously aligned in private markets," and "The music has stopped in private markets." Many thanks to both of you guys for this great conversation today.
Thank you, Mike.
Thank you.
I'm Mike Wallberg, and this has been The Enterprising Investor.